Let's start off with the Prescient Equity Defender Fund. It uses derivative protection strategies. That's to limit downside risk and protect the portfolio from capital loss. Now, the use of derivatives means the portfolio has less exposure to equity markets than a general equity fund, but more equity exposure than a balanced fund. Now, the extent to which derivatives are used depends on the cost of this insurance in different market conditions. Joining us from our Cape Town studios, Adriaan van Niekerk from Prescient. Adriaan, thank you so much for joining us today on Investment 360. First off, let's kind of get the underlying investment process that you use. Of course, very much based on quantitative tools. You're an active investor. Just walk us through these quantitative tools that you use in this fund.
Sure. The Equity Defender Fund, first of all, it tries to maximize the physical exposure to shares, and that uses our equity active quant process. So it is a three-factor model. It's purely quantitative, and the three factors, we look at value, we look at momentum, and also the interaction between value and momentum of shares to pick the underlying stocks. And then, of course, we have a protection overlay, and there we look at things like the volatility in the current market that will tell us how dear or how cheap protection currently in the market is, and that will then tell us where we want to put the levels of protection.
So, Adriaan, it's pretty much the level of volatility that, of course, influences the cost of that insurance, and then that, of course, influences the position, the amount of exposure that you'd like to equities, and then that protection for that exposure. Just walk us through the different market conditions and the cost of those on insurance.
Sure. If we look at the market currently, we see that volatilities have come down quite a bit. So what we like to do in a market scenario like this, where the market is quite high, we like to take as much protection as we can because the protection is quite cheap. If we talk about the cost of the insurance there, it's around about 7% of the equities to protect for a year going forward. So we won't cap out the insurance at the bottom part, like for instance, early in the year there was the volatilities was quite a bit higher, and then we sold out the protection so that if the market fell by more than 20%, say, it would fall further with the market. But in the current scenario, we are fully protected from 5% lower than the market.
Adriaan, just to clarify there, when you talk about this protection that you buy in terms of the derivatives that you use, specifically, are you using a range of different derivatives? In particular, are you using derivatives against equity indexes, or are you actually using derivatives to hedge out specific stocks that the portfolio owns?
That's a good point, Warren. We mainly use derivatives on the equity indices, so that can differ. We've used Aussie 40 options in the past. Currently we have Swiss 40 options. They are the most liquid options in the South African market. If you go and you want to protect the individual shares, normally the volatilities are higher on individual stocks, and you would end up paying a bit of a higher premium to protect those shares.
Adriaan, talk to us about the equities that you do hold in the portfolio at this point in time, and what type of sectors you're skewed towards right now.
Sure. If we look currently at the positioning of the equity carve-out of the fund, it is overweight the telcos and the financial shares. The quantitative model tell us that there's value and there's still some good sentiment in those sectors. We are pretty much neutral towards the miners that's not involved in the platinum and gold sector. And that's purely because the model tell us not to be there, not because of the things that's currently happening there. And then we very underweight the consumer goods and the consumer services sectors, and that would include your Richmonds, your Shoprites, all the retailers, as well as expensive shares like Naspers and Richmond. I mentioned SAB is another one.
Adriaan, just to clarify there, you use this three-factor model which takes into account momentum, what you call an interaction factor, and then a value factor. You said that the gold shares and the platinum shares are not finding their way into the portfolio at the moment. What are some of the shares that are undervalued and are being found by the value factor in your model?
Well, certainly Sasol and Billiton, those two shares are definitely coming up on the value screen, and they're now starting to find their way into the interaction factor as well, because the sentiment is returning. We've seen over the past 2 months that the sentiment towards these shares have turned relative to the other sectors, and it does seem like there's a bit of sector rotation happening in the past quarter.
So as you mentioned there, those are two resources, Sasol and Billiton specifically. When it comes to value, when it comes to momentum, are there any stocks that are sticking out in terms of ones that really have the momentum behind them right now?
Definitely. We see stocks like the health sector, Life Healthcare is in there. We also see Coronation, the momentum have come down a bit. But we definitely see the health sector is very attractive right now. But we also see some of the expensive shares, obviously the likes of SAB, that would come into the momentum factor as well.
Adriaan, when it comes to the benchmark, just walk us through the benchmark that you've chosen to use for this fund.
Sorry, can you just repeat that?
What benchmark are you benchmarking this specific fund against?
We have a benchmark of 70% of the SWIX and 30% of the Steffi call, so that's 30% in cash. And the main reason for that is that with the protection in the fund, we have a net effective exposure on average of about 70% to equities.
Adriaan, just in terms of you mentioned that the cost of insurance at the moment is quite cheap because of the lower volatility that you've seen in the market. For investors that would consider investing in the fund, what sort of downside protection is the fund protected against at the moment? In other words, if the market were to fall 20% at this point, how much protection would the fund see any capital losses in that scenario? And what is the sort of relative effect at the moment in terms of the protection that you can offer the portfolio?
Currently, the equities of the fund, so 90% of the fund is in physical equities, and the full portion of equities are protected from a level 5% down. So if the market falls by more than 5%, those equities would be protected fully. So it's fair to say that the fund won't lose more than 5% over a 12-month period.
And Adriaan, one of the other factors that you point out when it comes to achieving alpha in a market like this is also the uncorrelated nature of those three quantitative tools. You talk about the fact that because they're uncorrelated in the short term, it does help that outperformance factor. Just walk us through that explanation there.
Right. So when we build an equity model, the objective is to have stable outperformance relative to the benchmark. And one of the reasons why that's so important for this type of fund is you don't want to be in a scenario where you pay for the protection and then your fund underperforms severely. You would have quite a double whammy in terms of your performance. So it's important for us that the risk of underperforming our benchmark is small. But we also want to give investors that opportunity to have a model that performs consistently. So when we look at the three factors, we know that currently, or a month or so ago, value was really not in favor, and if we only had a value factor, we would have been severely hit. But we had the momentum factor that really helped us. So there already you can see an uncorrelated nature of these factors. So when you combine them, the equity active quant process really gives you a consistent delivery of returns relative to the market.
Now, Adriaan, the tricky thing is when I look at this fund and you talk about these the proprietary systems that you have to select the shares that go into the portfolio, you're using indexes to hedge yourself against the downside risk, and sometimes the correlation between the index and the performance of the shares in the basket is not matched. So when you screen the shares, do you also look at the correlation of shares between each other to make sure that the protection you're buying is in fact going to give you protection when this particular tailor-made portfolio goes down?
That's a good point. So first of all, we will look at the model, and the model would suggest the over and the underweights relative to the benchmark. Now, when we select these shares, first of all, we will adapt the model so that the over and underweights are relative to the protection. So currently, we're using SWIX 40 options. So our over and underweights would be over and above the SWIX 40 index and not the full SWIX index. But other than that, the nature of the quantitative model is to give consistent returns relative to the benchmark. So we believe the bottom-up nature of the equity active quant model to reduce the risk for us. So we don't explicitly look at correlations of the shares. We believe that the model itself is designed to mitigate those risks.
So would it be fair to say, Adriaan, that this particular portfolio is designed so that in very bearish markets like we saw after 2008, this portfolio would protect against capital loss, but because of the cost of insurance in a bull market, it won't rise as quickly as, say, an index like the SWIX index?
That's absolutely right. You can expect this fund to really outperform when markets go into deep drawdowns, and you can expect it to underperform or lag the market when we see strong up markets. There's 2 points to that. First of all, you don't have 100% effective exposure to equities, and the other one is the effect of the protection. As we see markets fall, volatilities also rise. So those the protection becomes more valuable. So it's almost a double whammy on the downside. And when markets rise, you can see that volatilities come down. So those options that you have in your portfolio, they become less valuable. So you do see that you lag on the upside.